Good afternoon, good morning, and good evening, everyone. Welcome to today's Future of Financial Information webinar. I'm really happy that we can kick off the spring 2022 season with a great paper and a great presenter, Clara Vega from Federal Reserve Board. Thank you for being here. And also thank you to Azaya Hall from the Riksbank, who will be the discussants today. And of course, thank you to everyone joining for the audience. You might think that after 2 years of being forced to attend all kinds of webinars, everybody is sick of it when they don't have to do it anymore. So I think it's a count double to see you here, and I'm sure it will be worth your time. So Clara will talk about something that's on everybody's minds, at least if you're interested in finance, the economics, which is central bank policy and specifically central bank communication, and how it affects the market response to not monetary policy itself, but other macroeconomic announcements. So just a little bit of housekeeping. Clara will present for about 30 minutes, followed by Azaya's discussion for about 15 minutes, and then we'll spend the rest of the time with questions from the audience. But if you have a question, you don't have to sit on it and worry that you might forget what you wanted to ask. Feel free to put this question in the chat, and I will be keeping an eye on the chat, and we'll make sure that that we get back to your question when it's time for the Q&A. Okay, so now without further ado, please, Clara, the screen is yours for 30 minutes.
Great, thank you very much. Do I need to share my screen again, yes, or you can see it?
Please, share.
I trust you can see it.
It's coming. Yes, there it is. Thank you.
Sorry for the delay. In any case, hello everyone. Thank you very much, Michał, for the invitation to present my work. It's a pleasure to be here, and I'm a fan of the webinar series you're organizing. So that's why I'm really happy to be here. I also look forward to Azaya's discussion. The paper I'm presenting today is co-authored with Clara, who's a colleague of mine at the Fed, and I believe she's also attending the seminar. So feel free to ask questions to either one of us. And the other co-author is Ben Gardner, who used to be our research assistant at the Board of Governors and is now doing a PhD in finance at Yale University. So you should watch out for him in a couple of days. I mean, a couple of years. If he's done with the PhD in a couple of days, that would be amazing. Before I tell you about the paper, I just want to remind you about the usual disclaimer, which is that the opinions expressed here are our own and do not reflect the views of the Board of Governors or its staff. Okay, what is this paper about? In this paper, we're gonna try to answer a question that is fundamental to economics and finance. And the question is, what is the relationship between asset prices and the macroeconomy? Recent newspaper articles state that the equity prices and the macroeconomy are disconnected, in the sense that during the pandemic, we saw the macroeconomy not doing well, yet equity prices kept on going up. And in general, when the macroeconomy is not doing well, we expect equity prices to go down. The lack of connection between equity prices and the macroeconomy is not only talked about in the media, is also talked about in academic circles. And usually what we do as researchers is take equity returns and regress it on macroeconomic news, which is the table that you have there. And if the coefficient in front of the macroeconomic news is not statistically significant, which is the case here, then we say that there is a disconnect between the macroeconomy and equity prices. There is a long literature that tries to explain why that is the case, and I'm not going to go through the literature, but I'm just going to mention two things that in my view are really important. One of them is that you really need to use high frequency data to identify the effect macroeconomic news have on asset prices. If you're going to look at monthly data or even daily data, it's kind of impossible to identify that effect. So in that table that I'm showing you there, I'm using high frequency data. I'm using 10 minutes before the announcement comes out and 20 minutes afterwards. And that's what we're going to do in the paper as well. And the second thing I wanted to mention is that the response of equity prices to macroeconomic news is time varying. So if you pay closer attention to that table, you'll see that the period I'm looking at there is 2014, 2015. It's just 2 years. And I didn't pick those years at random. I picked them on purpose based on the next graph that I'm going to show you. So the graph you see there, the red line is actually the coefficient that you saw in the previous table. And this time I'm allowing the coefficient to change over time, meaning that I'm allowing that coefficient to be different every year. And when I said that I didn't pick 2014 and 2015 at random, you can see in that graph that if you look at 2014 and 2015, that red line is close to 0 and is not statistically significant. What is obvious in the graph, though, is that the coefficient changes over time. So there are periods close to the recession, which is the shaded gray area in that graph, where the coefficient is going to be positive, high, and statistically significant. And then there are other periods where that coefficient is going to be low, close to 0. We're not the first ones to figure this out. Many people talk about this time variation, and most of the academic literature talks about expansions versus recessions, and you can see why in that graph. So the expansions is the white area in the graph, and the recessions are the shaded gray area. And you can see that in general, the coefficient is higher during recessions and is lower during expansions. But you can also see that expansions and recessions don't do a very good job in explaining the response, in the sense that after the recession, so if you look at after 2001, the coefficient is still pretty high and statistically significant. And the same thing happens in 2008, after the 2008-2009 recession. So the main point of this paper is to find another variable that can explain the time variation in that coefficient better than expansions and recessions. And that's what the next graph does. So basically, the main point of the paper is the blue line in that graph. That's the novel variable that we're going to talk about in this paper. And if you use eyeball econometrics, you can see that that blue line is actually going to explain very well the time variation in the response. So now you may wonder, what is that blue line? The blue line is what we call the FOMC sentiment index. And that's a new variable that we're going to develop by using textual analysis of the FOMC statement. So whenever the FOMC gets together and tells us what the monetary policy decision is, they also release a statement explaining what the monetary policy decision is. So we're going to take this program that uses textual analysis, and that program is going to read the statement for us. And then it's going to give us a number that is going to tell us whether we're going to be what I will call a good state or a bad state. So the good state is going to be a state when there is going to be economic growth, there is going to perhaps be inflation, and the FOMC is going to be likely to increase interest rates. So when you see that blue line to be high, that's what that index is indicating. And the bad state, which many times will coincide with, not many times, all of the times will coincide with the recession, it's going to be a time when there is no economic growth, there is no inflation, and the FOMC is not likely to increase interest rates. But what's nice about the blue line is that it's going to be low for a longer period of time than when the recession is over. In part, some of that is because the blue line is a real-time indicator, in the sense that the shaded areas are based in the NBR expansions and recessions, and that those are backward looking. We know that the NBR gets together after the recession is over, and then tells us afterwards, maybe 3 or 4 months after the recession is over, that actually the recession was over in the past. While the blue line is going to be the real-time indicator of what the FOMC is thinking about at that moment. And the other thing that makes sense of that blue line is that even if the recession is over, it's not likely that the FOMC will increase interest rates right after the recession. It will wait for a while until the economy is again back up running. Now, the second question you may have is, why is it that this blue line can explain so much the time variation? And the answer is theoretical. Basically, we know from Finance 101 that equity prices have both a cash flow component and a discount rate component. And the effect macroeconomic news have on the cash flow component is pretty straightforward. Basically, good news will have a good will mean that you have higher cash flows, and bad news means that you will have lower cash flows. But what's not so straightforward is the effect news will have on the discount rate. And basically what we're going to show you is that when that blue line is high, it means that when you get good news, it is more likely that the discount rate will be higher. And that means that the discount rate effect will offset the cash flow effect. And that's why you have that low red line at the moment. So let me just recap the paper in one slide. So we're going to ask two questions. The first one is, what can explain the time variation response of equity prices to macroeconomic news? And our answer is going to be that blue line. And then the second part of the paper is going to talk about why is it that this blue line can explain that response. And the answer is going to be that the blue line is a good predictor of upcoming FOMC decisions. It also, surprising to me, complements asset price information. And finally, it will also affect the market participants' expectation about the future state of the economy. So if you forget the rest of the talk, that's okay, because the main points are in the previous slide. But in the rest of the talk, I'm just going to give you details about how we construct the FOMC sentiment. How do we run these regressions, the equity response to macroeconomic news, and what are the properties of the FOMC sentiment? I'm going to show you a few robustness checks, conclude, and perhaps what I'm most excited about is to share with you the future research or the follow-up paper that we're writing. Okay. So how do we construct this FOMC sentiment? We're going to develop a user-defined dictionary. I don't think this is always the right approach when you do textual analysis. In fact, we think machine learning many times is a better approach. But the reason why I think this is a good approach for FOMC statements is that FOMC statements, if you've ever read one or two of them, you'll see that many words are repeated over and over. So basically, there is a very reduced vocabulary that the FOMC is using. And that's why we decided to go with our own user-defined dictionary. And so the first set of words that we're going to look for are what we call the topic keywords. And we're going to think about 5 topics. One is labor, output, inflation, financial conditions, and future monetary policy. And again, if you read an FOMC statement, those are kind of like the 5 topics or the 5 things that governors usually talk about. And the other set of words that are going to be useful for us are what we call the modifier keywords, which are going to be just adjectives and verbs that will tell us whether the word is used in a positive context or in a negative context. On the right, there is just a table to show you some examples of the keywords, and they're pretty straightforward. So the keyword, for example, employment is going to be in the labor topic, and the keyword price is going to be in the inflation topic. So like I mentioned before, basically the way we come up with these keywords is just by reading the statements and basically tabulating which are the words that are most frequently used. And like I said before, there is a very reduced number of words that actually governors use. So it turns out that we will only have 7 words that are associated with the labor topic, 18 words that are associated with the topic output, 3 for inflation, which is inflation, cost, and prices, and 3 for financial conditions. What's a little bit more complicated is the phrases that governors use to describe future monetary policy. So there we don't use keywords, we actually use like a full sentence to describe whether the FOMC is thinking about increasing interest rates in the future or not. On the right-hand side, you have a plot of the frequency of the words. That's not the sentiment, just to show you that, to me, it's interesting that sometimes the governors seem to be more focused in one topic versus another. So the example is that, for example, that at the beginning of our sample, the governors were really focused on output, not so much on inflation and labor, but later in the sample, they talk more about labor and inflation. One of the reasons this was surprising to me, I thought maybe we always talked about labor, but it looks like really at the beginning of the sample, that was not the focus of the FOMC. And our thinking is that even though Bernanke started at the Fed, he was the chair of the Fed in 2006, it is true that after the financial crisis, there was a lot of focus from Bernanke's perspective, making the difference between Wall Street and Main Street, and that's why perhaps there was more focus on labor. But in any case, the takeaway here is that some topics are emphasized more than others over time, and maybe the output topic is the one that is covered maybe throughout the sample, which perhaps is not surprising. So those are the topic keywords. And now the second part of the algorithm that is important is the modifier keywords, which are just adjectives and verbs. So what the modifier keywords are going to allow us to tell you is whether we're in this, what we call the good state or the bad state. So the examples I have there is basically in a sentence where the FOMC mentions low unemployment, you have that the topic keyword unemployment is going to be caught by our program. That's going to be the topic labor, and the program is going to give it a -1 for the topic because higher unemployment means we're more likely in the bad state than in the good state. And then the modifier keyword low is also going to be caught by the program, and then the multiplication of the two will tell us what is the sign of that modifier topic pair. It's just going to be +1. So actually low unemployment will be one signal for the positive state. And then you have the same thing for labor market conditions deteriorated, where this time the labor market conditions will have a 1, the deterioration will have a -1, and the multiplication will just be a -1. So you can see that, you know, the method is actually pretty simple and straightforward. Once we have the topic modifier pairs, we're just going to add them, and we're going to divide by the square root of the number of words in the statement. And we do that separately for each topic, and then we're just going to add the topics, and that's what the FOMC sentiment will look like. That's the red line in the bottom graph. That's the line actually that I showed you at the beginning of the presentation. That's the line that is going to help us explain very well what's the time varying response of equity prices to macroeconomic news. In the paper, our sample is going to be January 2000 to January 2020. But in the follow-up paper, we have basically data going, you know, all the way to 2022. So let me give you a few details about the regression we're going to run. So basically, we're going to have equity returns. We're going to use the E-mini S&P 500 futures and Thomson Reuters tick history, because we really want to use this high frequency data to identify well what's the effect of the macroeconomic news on asset prices. The way we estimate the surprise is pretty straightforward. Basically, we're just going to take the actual announcement minus the expectation derived from Bloomberg, and we're just going to divide by the standard deviation, which is just a constant throughout the sample, and that means that it's not going to affect the statistical significance of surprise, but it's going to allow us to interpret the coefficient on the surprise very easily. Now, which macroeconomic news announcements do we choose? There, I've just listed, we look at the non-farm payroll, initial claims, ISM manufacturing, and the consumer confidence index. There are actually 32 or 36 macroeconomic announcements, and the reason we don't look at all of them, and in fact, Kat and I have another paper that talk about this, is because not all of them are important, in the sense that the announcements that you see there are the first ones that come out in a period, so they're the first ones to give you information. So non-farm payroll is always released the first week of the month, and is sort of like one of the first signals of how the economy is doing, while let's say GDP is released on a quarterly basis, and by the time GDP is released, we know a lot about the economy already, because there are all these other announcements that are telling us something. So this is just a long way of saying that, you know, we pick those announcements because other literature has picked them, because they are important, and we do some robustness checks and we look at other announcements. And the bottom line is that our results are robust as long as the macroeconomic announcement that you're looking at is important in the sense that it has fundamental information. I'm not sure how well I'm doing with time, but here's just the next 3 slides. I just have a list of all the variables that we use as controls. And so rest assured that we're going to make that blue line, our FOMC sentiment variable, competes against a lot of other variables that other people have looked at. So obviously we're going to have the NBR dummy variable, but we're also going to have a real-time business condition index, the Aruba Diebold-Scotty index. We're also going to have, you know, employment gap, price to dividend ratio, VIX index, which is even more high frequency, and it would be a variable that is controlling for uncertainty. So if you think what's driving the time varying response in equity prices is more uncertainty than the monetary policy, then you see that we have that control there. We're also going, yeah, I have 10 minutes, great. Thank you, Michał. We're also going to control for the policy stance and the federal funds target rate change. The reason why we use the policy stance indicator as opposed to the federal funds target rate is that throughout our period, there are periods where we hit the effective lower bound, meaning that interest rates cannot go any lower, but it is true that central banks were still doing unconventional monetary policy, basically asset purchases. So that's why it's important to not only look at the federal funds target rate change, but also the policy stand indicator. Okay, so let me go back to how do we answer this first question, which is what can explain the time varying response of equity prices to macroeconomic news? I mentioned at the beginning of the talk that there is a theoretical reason why our FOMC sentiment will explain this variation very well. And I'm going to call this theory the monetary policy theory because I don't have a better label for it. But you'll remember that basically equity prices have 2 components, the cash flow component and the discount rate effect. I already mentioned that news have a very straightforward effect on the cash flow effect, but it's not so straightforward for the discount rate. So the effect news have on the discount rate will depend on what the FOMC is likely to do. And what is interesting to me is that it could also depend on whether there is uncertainty in the economy or whether investors are demanding higher compensation for the risk that they're taking. And what is interesting is that these 2 theories will actually have opposite predictions. So what I call the FOMC prediction is the one that I labeled there 1. The FOMC prediction will be that good news have a bigger impact on equity prices during bad times. And that's exactly what you see in that graph that I show you. During recessions and where the FOMC sentiment index is low, you will see the coefficient to be bigger. And the reason mainly is that when you are in a recession and you receive good news about the economy, the FOMC is not likely to increase interest rates. So this means that there's not going to be a discount rate effect that is going to offset the cash flow effect. But there is also an alternative theory that I'm going to call the Veronesi 1999 theory, where he wrote a very nice paper, in my view, that basically says, when you receive good news during bad times, that means that uncertainty is going to be higher. And the reason why it's going to be higher is because the good news is opposite to the times where you are. So this means that investors are not going to know whether we're still in bad times or whether we're moving to the good times. But when uncertainty is higher, this means that investors will demand higher compensation for the risk that they're bearing, which means that the discount rate is going to be higher, and the discount rate is going to offset the cash flow effect of the good news, which means that the response should be lower. So basically, the two theories have opposite predictions. In this slide, I sort of like just summarize what I told you, maybe with more words, but the bottom line is that there is something that I will call the Fomc theory that is telling me that during bad times, there should be a bigger effect on of news on equity prices, while the Veronesi theory is the opposite. During bad times, you should see a lower impact of news on equity prices. And then just telling you what I said in the figure with eyeball econometrics in a more formal way, we're going to run the regression where you have the equity return regress on the surprises, but this time we're going to interact the surprise with our FOMC sentiment and all the other variables that I mentioned before to control for other things. And the bottom line there is that the FOMC sentiment coefficient is going to be statistically significant. It has the right sign in the sense that when FOMC sentiment is higher, the response is going to be lower, and is one of the best predictors of this response. Let me skip this, which is just summarizing what I said, and move on to how do we answer the second question, which is, what is this FOMC sentiment index really telling us? And the first set of results that I'm going to show you is just going to show you that this FOMC sentiment indeed can forecast upcoming FOMC decisions. So it's not only telling you something about the current FOMC meeting, but it's going to tell you something about future meetings. Because it tells you something about future meetings, then it is obvious, obvious, but it is also going to be true that if I regress interest rate changes on this FOMC sentiment, I'm going to see this FOMC sentiment affecting interest rate moves, and mainly in the middle of the yield curve. So not so much in the short end or the long run, but in the middle of the yield curve. And then finally, I'm going to show you some regressions showing you that professional forecasters will also update their expectations based on this FOMC sentiment. So in other words, it looks like professional forecasters are also reading this statement to figure out where the economy is going to go. So this is just a bunch of numbers, and I know I'm running out of time, and I want to show you one slide that talks about the future, but here basically we're just going to do an order profit regression where the dependent variable is going to be a 0-1 of whether the Fed is likely to tighten monetary policy or not. And on the right-hand side, you're going to have a bunch of explanatory variables. And the bottom line is that the FOMC sentiment is statistically significant. Here is a regression that I mentioned about interest rates with different maturities. And the bottom line here is that the FOMC sentiment does well in the middle of the yield curve. And then the last regression is this one about the expectations of professional forecasters regarding GDP, unemployment rate, and inflation. And again, the FOMC sentiment is informative. And here I'm just showing you the aggregate FOMC sentiment. But if you look at the topic, so if you look at the output sentiment, the labor sentiment, and the inflation sentiment, that does even a little bit better. So let me just mention the robustness. So in terms of predicting monetary policy, I show you that what we use is the 1, -1, and 0, depending on whether the Fed is not only tightening monetary policy, but also doing unconventional monetary policy. And the results also go through if you only use the target rate changes as opposed to this 1, -1, and 0 variable. We also look at the subcomponents, and like I said before, the output actually sentiment is the one that it works best, but that's mainly because we talk about output throughout the sample, and I wouldn't say that that's going to be the same for the future. Now, for example, that inflation may be more in focus. We use alternative dictionaries, so we also use the Logren and McDonald dictionary and show that our smaller dictionary does better. I also mentioned that we just add the sentiment across topics, but we can also do a principal component. Like there are other ways you can aggregate the sentiment, but it turns out that actually the addition does better than, say, the principal components. So it may be that the information, let's say, in output and inflation is not always highly correlated, but they're complementary. So that's why I think the summation does a little bit better. And then one final thing I wanted to mention is that we look at the COVID sample, and that what's interesting to me, and I motivated the paper saying that, in the newspaper, they talk about this disconnect. But what's interesting is that actually our FOMC sentiment does not do very well in explaining why equity prices have a low response to macro news actually during the pandemic. And this is why we mention in the paper that even though Veronese's theory in general does not hold, it seems to explain better what's happening in the pandemic. So maybe Veronese's theory is true when uncertainty is so high, like it was during the pandemic. So that's all I have for the paper. And let me just quickly, before Isaiah discusses the paper, tell you about the follow-up that I'm very excited about. And in the follow-up paper, we're going to look at an FOMC sentiment, not only of the statement, so not only from the governor's communication, but we're going to do an FOMC sentiment based on the media coverage of the statement and the Twitter coverage of the statement. And the idea here is to sort of ask a question, do media and Twitter, are they echo chambers? Are they just repeating whatever the FOMC is saying, or do they give us additional information to help with the price discovery? And what I found very interesting is that the media sentiment actually doesn't do that well in explaining the high frequency response, but it does really well in explaining the end of the day response of equity prices of interest rates. Actually, we look at response to the news at the end of the day. That's all I have. Thank you very much. And I'm looking forward to the discussion.
And as we move over to Isaiah for the discussion, let me just remind everyone that the chat is open for your questions, and we will get to them shortly. But first, Isaiah, please, the screen is yours for 15 minutes.
Okay, can you hear me? All right. Okay, so I'm Isaiah Hull. I'm a senior economist at the research division of the Riksbank. I mostly work on computational economics. So I work on quantum computing and machine learning applications in economics. Actually, a lot of my machine learning work is concentrated on NLP and central bank communication. So this was a very nice match for me. I really enjoyed reading the paper, and now I'm looking forward to the extensions now that I've heard about them. Okay, so the research question in the paper, as I see it, is how does Federal Reserve communication affect the financial market's response to news about fundamentals? What are news about fundamentals? Well, we might want to track the underlying state of the economy through different variables like, say, activity in manufacturing. And the way in which we can do that is observe news releases about, say, the ISM manufacturing index. Now, between news releases, all we can do is try to forecast what the ISM index will be at the next release. And so, this gives us an expectation of the ISM, which is telling us about manufacturing. And then when we have an actual realization, when information is released, we'll observe some difference between its expected value and the actual value. And this should, in principle, cause us to revise equity prices because we learned something about the underlying state of the economy. Now, what role does the Federal Reserve play in this? Well, the Federal Reserve endogenously responds through the news themselves. So if they get good news about manufacturing, then the Fed may decide to tighten. And if they get bad news, they might decide to ease. And so the Federal Reserve plays some role in potentially either amplifying or dampening the response of equity prices to news about fundamentals. And so this is why we have to explicitly consider the Fed's role when we think about the effect we're likely to see. So specifically, the authors, Clara and co-authors, are looking at Federal Reserve communication to try to gain some insight into this intermediating role that the Fed plays in affecting the response. Now, why do we think that the Fed plays a role here? Well, if we look at the literature, we can see that at least, from theory, we'd expect that there would be this effect of news on equity prices, but actually early work, including work by Schwert in 1981, finds that actually the unconditional relationship is quite weak. But then, when we actually condition on the state of the economy, we find that there is a relationship in certain states. In particular, when the state of the economy is bad, that's when we tend to see stronger effects. So we also have the Veronese hypothesis, but they mostly confirm the bad times hypothesis. So I'll focus primarily on that with my comments. Now, the reason for this that's hypothesized in the literature, but isn't really confirmed until Clara's paper, is that the Fed in bad times is constrained. So it can't raise rates, or it doesn't really make sense to raise rates when you're, say, in the middle of a recession. But at the same time, especially if you have a persistent recession or a very slow expansion, you reach a point at which you can't lower rates either. So if we think of the period that followed the 2007 to 2009 financial crisis, this matches this description almost perfectly, in the sense that there was really nowhere for the Fed to go. Well, if the Fed is constrained, it can't either increase or lower rates. Then when either a bad or good news shock is realized, equity prices are going to fully absorb this because there will be no response from the Fed. So this is why we expect, in bad times to see bigger effects of news shocks, because we don't have any Fed response to the shocks. Now, they approach this problem by constructing a text feature based on FOMC statements, which are released concurrently with the Fed's federal funds rate decisions. And what they try to do is measure sentiment in these states to see whether the Fed itself is describing the state of the economy in a positive or negative way. They use a different type of dictionary-based method than is common in the literature. So the Lawford McDonald dictionary is heavily used, but we have a lot of evidence specifically for central bank communication that smaller dictionaries, which are focused on words that are used frequently in central bank statements, actually work better. And so this is what they focus on. And so, as Clara explained it, the reason why using a dictionary-based method in general works for FOMC statements is because that's how central bankers talk. They have a selection of phrases and a selection of modifiers, and they intentionally construct statements in a way that uses this fixed set of words. So a dictionary-based method makes sense in this case, and the particular type of dictionary-based method they use has a history of working well. So they also divide their dictionary into multiple subtopics, which allows them to gain insights into specific dimensions of the statement. And actually, I'll come back to this a little bit later, because I worked on a similar dictionary with co-authors, and I have some ideas for how this might be used beyond just measuring sentiment. Okay, then ultimately what they try to do is evaluate the impact of the news sentiment interaction on equity prices. And so they focus specifically on news releases that are actually likely to be salient. So we have news that's being released all the time, but the content of the news is so small in describing the underlying state of the economy that you don't expect it to have a meaningful impact on equity prices. So they focus on four, which are very commonly cited by analysts and central and the Fed and so forth, and thinking about the underlying state of the economy. Okay, so the two main findings, as I see it in the paper, is they find that the impact of news on equity prices is strongest when FOMC sentiment is low. And so this provides support for the hypothesized mechanism in the bad news or bad times part of this literature. So, now we're not just saying, when the state of the economy is bad, when we're in a recession, but we're saying when the Fed is negative, that is actually when it looks like we see the biggest impact from news. So when the Fed is assessing things to be bad. And they actually find that this effect is bigger than the bad state itself. So the Fed's own, assessment of what they can do and what the state of the economy is actually more important. So this provides strong evidence for the original, hypothesized mechanism here, evidence that doesn't otherwise exist in the literature. Otherwise, we just have people saying, maybe the Fed could be what explains this, but here they actually demonstrate this, quite convincingly in the paper. Then they also try to spell out exactly, how all of the different pieces of the mechanism work. So they show, it's not just that, sentiment tells us about the response of equity prices, but actually we can see, we can predict the Fed's decision-making, using sentiment. So that tells us that the mechanism that we're hypothesizing also works, because we can show that, if the Fed is more positive, it's actually more likely to raise rates. Okay, so to summarize my comments, this is a very polished paper, so I don't have very strong, recommendations for making big changes. Most of the comments I have are going to be fairly minor, mostly suggestions for extensions. But overall, I'd say the paper is very carefully connected to questions of interest in the literature. So there's this big news shocks literature, and it also adds substantial value to the discussion. So we have a hypothesized mechanism. A lot of people, we see a lot of evidence for it, but nobody directly tests it. And now we have a direct evaluation of that mechanism. And most importantly, an evaluation that uses essentially best practices in the literature. So high frequency identification, that's typically what we see in the central bank communication literature, so that we can rule out the possibility that some other thing is happening at the same time at driving it. Okay, so the first comment that I have is about the timing of the relationship, and Clara already talked about this to some extent. So here we have the effective federal funds rate series, and we can see, we have a few recessions in the sample that they have in their data. And immediately following, the 2001 recession, we can see that the federal funds rate is low, but we haven't hit the ZLB, ELB. So there's actually more room to continue lowering rates. Whereas after the 2007 to 2009 financial crisis, we of course have this very long ELB period. Now, if we look at the impact, if we look at the measured impact that they show in this nice rolling regression, we can see that the impact or the strongest stock market response that we can see is somewhere after 2007, 2009, and also in 2002. But then if we look at, the period that aligns best with the hypothesis that's articulated in the literature, so, we can't raise rates, because we're worried that the economy is still too soft. We don't want to tighten. And at the same time, we're at the LB, so we can't lower them. If we look at that period, there we actually see, we see coefficient estimates that are statistically indistinguishable from zero. So in, say, 2013, 2014, 2015, we're seeing that actually the impact is quite weak, even though it's clear that on the downside, the Fed is highly constrained. So what I take from this is that at least in the sample that they're looking at, tightening might be the more important constraint empirically. We have some reason to think that tightening might be quite important during this period. So I have worked with co-authors in which we use transfer learning to look at agreement and Federal Reserve transcripts. And one of the things that we find is that there's a strong asymmetry in the sense that the Fed is very unwilling to raise rates unless there's strong agreement among committee members. So they don't want to go public and potentially have a lot of discussion of dissent, whereas if they're going to lower, agreement is much less important because perhaps because they're much less likely to receive lots of media criticism for, say, a premature easing than a premature tightening during a weak expansion. So we think it's possible that during this, this period that tightening is particularly important for their mechanism, perhaps because, especially when we're thinking about what does sentiment tell us? Well, we already know that we're at the ELB. But if all of a sudden, sentiment becomes very positive, then perhaps we learn that, the Fed's internal assessment has changed, and it's now telling us that the Fed is open to tightening, which is something that we can't observe otherwise. So there, I think it's possible that sentiment is particularly valuable for this reason in the sample that they look at with a long ELB period. Okay, the other comment that I had was about the specific components of the dictionary. So I've worked before with a dictionary that has multiple components, and one of the issues that we had, which they also discuss in the paper, is just that certain components are essentially undefined in different periods of time because the Fed isn't talking about the labor market, or it's not talking about financial markets. So you have a noisier undefined measure. And so I thought one alternative way to use the dictionary, where they're doing, they construct the dictionary using descriptive analysis of the text, so they're finding out which keywords and key phrases are being used, is to actually do a classification of the statements to see, is this statement about labor, is it about the financial market, and so forth. So you have, a measure of Fed focus in terms of topic that is actually separated from the scored version where you also add the modifiers. So I thought that was one way you could potentially use it, and then you can compute shares, or you can compute dummies that indicate that something's about labor or something is about financial markets. Okay, the last comment that I had was about information effects. So the authors mentioned that one of the things that they could be picking up is an information effect. So, when the Fed is positive, it tells us something about what the Fed will do, that it's perhaps more likely to raise rates. But it also tells us about the Fed's internal assessment of the economy, which we don't have perfect access to. Which the general public doesn't have perfect access to. So it actually releases information about the Fed's beliefs about the state of the economy. And this is an independent source of information that may be valuable over other forecasts that are available. So they actually do, an evaluation of information effects in the paper in an empirical exercise, but my recommendation would be to consider an additional alternative test where you make use of specific information that the Fed has. So for instance, you can use Green Book and FOMC forecasts, as a measure of the Fed's internal information, or you can use one of these decompositions that, look at the policy component and the information component, like the Nakamura and Steinson ones, or the Jaruzinski and Karate decompositions. There you have series that they've made available from their paper, which you could very easily include as a control. And I'll stop there.
Excellent. Those are really, really good recommendations, as I am looking forward to read your paper about tightening appearing to be more the real constraint here. I guess I just wanted a little bit of clarification on your second comment, because this is something that we've thought about hard, and maybe in the follow-up paper it'll be even more important. So did I understand correctly, to make the sentiment less noisy, we should really classify a sentence as either labor or inflation, not both? Like, if the prevalent words are more about labor, then we should turn off the inflation. Is that what you have in mind?
So I thought you could compute sentiment as you do right now in aggregated form. And that's essentially what we decided to do in the end for the same reason. But I thought you could also use the dictionary that you constructed, which contains a lot of information about how the Fed talks about things, to just separately discern what their focus is in a given statement. Is it about labor? And so that could be an independent control. Then you might see when the Fed is talking about, financial markets, then sentiment bites harder. Or when the Fed is talking about labor.
Oh, I understand. So weighted, maybe not completely turn it off, but weighted based on the importance of a topic in a given statement. Yeah.
Yeah.
And then the last comment is a great one as well. I mean, to me, it's really difficult, I think, to disentangle the information effect from the FOMC effect, because, I mean, naturally, they're just correlated, right? Like, if we're giving information about the economy, we're also giving information about what we're going to do in interest rates. So, yeah, maybe we can use those two indexes that you mentioned. Thank you.
Let me thank Isaiah very much for the discussion. Let me also thank Clara for presenting. And finally, let me thank everybody else for attending today's webinar. We will be back in 2 weeks' time with Kai Li from Peking University, who will dissect climate-related corporate disclosure for us. So another very timely and very exciting topic. So I hope to see you there. Have a great rest of the day. Thank you.